to the Currency Exchange, NatWest Markets FX podcast, where we help to break down the major themes and events driving currency markets this week and in the weeks ahead. Today, I'm joined by none other than our head of ESG and emerging market strategy, Alvaro Vivanco. We are focusing on the big themes for emerging markets and specifically why some EMs have been so resilient to all these concerns about kind of slowing global growth and recessionary risk. Alvaro, what kind of explains EM's outperformance and what you think is the main driving theme for EM at the moment?
Yes, hello everybody. Thanks, Eimear. I think it has been very straightforward, right? Over the last few months, carry has really been not only the main, but in some cases, the only driver for FX performance. If you review how different currencies have done over the last 6 months, is essentially the ranking of carry, both because it comes from the positive yield differentials for each currency, but also because the market has tended to favor those currencies. So you have a spot appreciation on top of the positive carry. And this is something that we have been discussing really since last year. I also think that there are a couple of domestic factors that have helped in this process. The first one is that trade balances for the vast majority of emerging markets have been improving. And that's a reflection of both the fact that because central banks have tightened monetary conditions, imports have decreased, or at least the growth of imports has lowered. And commodities and most exports for EM have been fairly robust. We obviously haven't seen a huge rally, but the combination of those two factors have resulted in better trade balances. The other one is that we have seen some inflows into local fixed income markets, but still kind of the positioning suggests that there's still more room for that. And I guess the last factor is that geopolitical noise has really not been a negative force for emerging markets. In fact, we've seen a little bit of the opposite, right? We've seen that domestic politics in a bunch of places, not all of them, but in a few cases at least, have improved. So these concerns about fiscal or monetary policy irresponsibility has really not happened, and that has helped some currencies to catch up. So that has been the environment. We still that those themes are still in place. Obviously, the levels getting tighter and tighter. So it's difficult, to add to emerging markets at these levels. But from a top-down perspective, we think that those are essentially intact and will continue to support emerging markets over the next, at least I will say, the next few weeks.
I guess in your region, Latin America has really stood out. It's had the biggest kind of carrying offering with a few exceptions. What are your kind of highest conviction views right now in terms of the LATAM complex?
We still like Mexico and Brazil. Those have been favored, precisely because of carry in both cases. But I will say, especially in the case of Mexico, the central banks have been so cautious in signaling any kind of easing down the road, even when inflation has decreased significantly, right? So in the case of Brazil, for instance, policy rates are at 13 and 3/4, and inflation is at 3.5%. So the real yields, the real policy rate is just massive compared to any other emerging market, but also compared to the history of Brazil. Same thing in the case of Mexico. And because of this, because of the tightening of monetary policy, the trade balances in both places, but especially in the case of Brazil, have improved significantly. So you have positive carry, you have improving trade balances, and then you have an external environment that I think has almost the exact composition of risk and positives that you need for emerging markets like this to perform, right? Because the Fed has obviously paused. It's not all clear in terms of the inflation, disinflation process in the US, but also the US economy has held extremely well compared to expectations, even in some of the service areas. So just to give you an example, remittances from the US to Mexico, which have been by far the biggest inflow over the last couple of years, continue to increase. So they're actually for the first quarter of this year, 10% higher than they were last year. So again, the US consumer has weakened. I think that Brazil still, the real still has more room to go. I think same thing for Mexico. Obviously, we're following what the central banks are doing a little bit more carefully. We're following the levels, but in general, it's very, very difficult to go against these themes that, continue the data continue to support them.
And obviously, it's so hard to be short a currency that has high carry as well. And I do have to draw you on you're talking about kind of global growth. And China was kind of, the policy lever that really failed to deliver at the start of this year. There was all these expectations that consumption-led China, recovery didn't really come through. And we haven't seen any signs of it peeking through yet.
No, and we think it's eventually going to come, but it's kind of too early to play that. Certainly on the FX side, right? We still feel that weaker currency is the theme to stay, at least for the next few weeks. I think that we have pretty much the opposite of Latam, right? You have very low policy rates. You have a bias from the policy perspective to ease at some point, right? Given the disappointing growth that you have had in China. And I think that this has been, the most interesting thing about China, right? That it really did not impact the rest of the markets and the rest of emerging markets. They have continued to do well, even currencies and countries that are very dependent on Chinese growth, but it has been very much a domestic factor because the starting levels of rates are so low that any easing from here is seen as adding additional pressure. So there are some reasons to be a little bit more optimistic towards the second half of the year, but we think that the bar for them to materialize is still fairly high, especially as the policy making on both sides of the equation seems to suggest some easing down the road. The other point, and this is something that Galvin has been making over the last couple of months, is that there are alternatives to China, even within Asia, right? And India, I think, is the best example of that it offers higher yields, it offers a more robust set of fundamentals from the growth, from the export side. So it's not all about expressing even a regional view through the Chinese currency. So what would it take for China to turn around? We think that essentially we're going to need a much stronger dollar for that to happen, right? The rest of the EM has been very resilient, even though we have seen bouts of some dollar strengthening more recently. And I think we also need kind of a shift away from the high carry currencies into more of the value stories. And I think once that happens, China can start to benefit. But until those things materialize, we're very comfortable being, more the defensive side on China. I wanted to put the question back to you and your region also, or some currencies where you have been a little bit more concerned because of the domestic fundamentals, such as South Africa, right? This has been really the exception of our more positive view for EM.
Yeah, I feel like South Africa almost is the opposite of all the other emerging market currencies. So, you talk about kind of high carry currencies. South Africa kind of never really had the inflation problem of other kind of global emerging market economies. And they always have imposed kind of fiscal restrictions and interventions on electricity prices that never followed through into a big domestic inflationary problem. So because the central bank didn't have to hike as much, and therefore the currency really doesn't offer you the same degree of carry as other EMs. But you've got to add on top of that the fact that there is a lot of domestic risk. I think chief among them is the fact that they kind of have a basic kind of collapse in basic infrastructure in the economy. So there's just this chronic electricity shortfall. They can't produce enough to power their entire economy, and they're on an ongoing basis doing electricity rationing. It actually has slowed in the month of June, but we think that it's just a temporary factor, and that rationing will be ratcheted higher over coming months. And the other big risk is when it comes to US-China relations. It feels that South Africa more and more is going to be pulled into the sphere of influence of Russia and China. They're recently accused of actually outright giving weapons to Russia and loading them onto a sanctioned Russian ship. So this is something that could incite, US retaliation in the form of losing preferential access. So I have to say, it's not all rosy in emerging markets. And I think the fact that it doesn't offer, the high carry to compensate investors means that, there's very little reason for investors, to allocate to South Africa. And we certainly see that kind of playing out in their bond and equity flow data. And then I guess the other kind of place where we're a little bit more bearish, though I have to say it's holding up pretty well, is Hungary. So Hungary has, very high carry, which is kind of a very kind of directed policy by its central bank to reinforce the currency. But it's actually, one of the first emerging markets to start cutting. And, even despite the fact that they're cutting rates when inflation is above 20%, the currency is resilient because investors really believe that they can cash in on that carry for the next month. And we think, investors are being complacent. There's significant risk. Again, Hungary is kind of caught between Western allies and China and seems to be kind of siding with China and building very strong investment links. But also on the fiscal side, they have, had to fork out so much money when it comes to implementing this extensive system of price caps in order to try to orchestrate lower inflation. And they've also done very strategic asset buyouts in key sectors of the economy. I know it's something you talked about before, that we're all very much focused, I guess, on the monetary policy response to COVID, but no one's really looking at the fiscal side just yet.
Yeah, I think that's going to be a theme that possibly comes more into focus into the second half of the year. As this kind of EM and global high carry definitely peaks and starts to move, there certainly seems to be a lot of opportunities for relative value trades, like the ones that we have been highlighting over the last few months. But also maybe we're moving into an environment where the dollar could make a little bit more of a comeback. It's not clear to me that, the positioning in EM is very extended, but certainly there are a few pockets, right? I think you talked about Hungary. I think Mexico, despite the excellent fundamentals, right, there is some accumulation of longs there. So those are kind of the themes and kind of the trends that we're looking for the second half of the year. For now, I think that it's very difficult, as we have discussed, to be long outright dollars. So we're still kind of benefiting from this last leg of high carry in EM, which, it's important to highlight, right? This is historically very, very high carry. We have to go back decades to see real rates in some of these countries as high as they are now. And, it still reflects a normalization process post-COVID that is taking a little bit of time to unravel for good reasons, right? Because inflation in some places has been a little bit sticky, but at the same time, globally, things seem to be moving in the right direction.
Yeah, and I think there is kind of an optimistic area. Like when you look at kind of Brazil and just the collapse you've had in inflation, actually a lot of EMs, inflation is really decelerating fast, as you say, kind of factoring into historically high real rates. That's probably about all we have time for this week. Alvaro, thank you so much for joining me. If you did like the podcast, please do click like and also remember to subscribe so you can get the latest episode first. Thanks again.